Sridhar Sivaram joins us, investment expert. He represents Enam Holdings. All right, let's take a deep breath. What should we start with? NBFCs will have to pay more taxes. FIs are confused about the new tax regime, or pure simple view on the Nifty?
I think it's tough to take a view on the Nifty, but I would say that the broader market is looking very interestingly poised. So just seeing some statistics yesterday that out of the total roughly 2,800, 3,000 stocks that they trade, around 65% of the stocks are down more than 50%. And another 25% are down between 25 and 50%. So that's the opportunity set that we are looking at, that the broader market has literally collapsed. And there are enough opportunities there. Now, do I think the Nifty will go up 15% from here, 10% from here, down 10%? Very difficult to take a call. But if I take a 2-3 year view, the opportunity set in the broader market is looking very interesting. So that's where we are looking at.
Okay, now there are two ways to have a quick follow-up question. I understand stocks have fallen down, but some would argue and say that, look, they went also higher at unrealistic levels. So don't get trapped just because stocks have fallen 30 to 40%. One. Yeah. Second, do you genuinely feel that in the broader market, in the economy per se, we are in for a strong recovery? Because every data which we've got, barring one or two data points, nothing seems to be indicating that, forget about this quarter, even a recovery is coming in next quarter.
So yeah, it's different for people who are looking quarter se quarter tak, and for investors like us who play across cycles. For us, this is a cyclical slowdown that we think is currently underway. If that sort of an argument is not accepted, then you can't do anything in this market. Our belief is this is a cyclical slowdown. Whether this cyclical slowdown will last for 1 quarter, 2 quarters, very difficult to say. But when we look at many of the stocks from their historic perspective also, forget where it went. 1-2 standard deviations below their long-term averages. So that's where we are looking at good companies, no debt, consumer franchise, or even good franchise on their own. There are enough opportunities available across sectors. But the question is, you need patience. So it isn't as if you buy today and you're going to get returns tomorrow. It could test your patience. I remember my starting in this market was 1994, and 94 to 99 was the longest bear market. So I started with 5 years of bear market, and I've seen how stocks just don't perform. So I think if you keep those things in perspective, it'll be easier for investors to understand the difficulties in the market.
Okay, so it's interesting that you're saying that, because we were talking this morning as well about how perhaps investors need to now approach markets a little differently. Good to hear that you still have a positive view, even if it's in a little longer time frame. What then would you say would still be an attractive bet or an opportunity? Let's not call it a bet, but an opportunity at a time like this, when you were expecting the economy to revive down the line, let's say in 6 months to a year. Where would you say the opportunities lie? So
a lot of them are stock specific, because we're doing really bottom up stock picking. But from a sector standpoint, I can say that maybe two-wheelers, auto ancillary, many of them are looking very interesting.
So in that context, are you expecting the entire EV imbroglio to kind of force these companies to pivot and just continue to grow?
See, to start with, I don't think you can force EV on anybody.
Sure.
And I think this whole government's approach of trying to force something on people is not going to work.
Okay.
Eventually, this will take over. Whenever there are disruptions, it happens because of natural choice by consumers, not because of some regulatory stance. So eventually it will happen, but I don't think that it is in the near term that is going to make too much of a difference. We think what's happening currently is because of some regulatory change and cyclical slowdown, both combined together, which eventually will change. This cannot continue for too long. So that's how I said.
And the companies will adapt to the...
Exactly, and the companies will adapt, and these are good consumer brands. So we think that there are opportunities here given where the valuations are. Doesn't mean that the slowdown is not there. It's very much there as we speak, but typically that's where you get the best opportunity to buy.
I'm going to put a graphic which talks about where the bond yields were about a year ago.
Yes.
I mean, normally we don't talk much of macro, but given where the bond yields are, they were at 8% plus, now they're sub 6.5%. Suddenly, the dynamics of borrowing in the system will change. What is the best way to participate in this market when it is now abundantly clear that interest rates will only head lower? It's 25, 50, 75, 100 bips, I don't know. Interest rates are headed lower and markets will start changing the way they view valuations and P multiples. What is the best way to participate in that?
So, one, bond yields have gone lower, but I don't think that the interest rates for the consumer or for the companies in general have actually gone lower. So eventually the transmission will happen. So currently, I think if you ask me, the biggest beneficiary is the government because it's actually getting almost 200 basis points lower than where it was borrowing, say, even 6 months back. So I think to start with, I think I'm quite happy with how Reserve Bank has reacted over the last 6 months, and thanks to the new governor, because prior to that, we had quite a bizarre stance when inflation was at 3%, we were at calibrated tightening, and I just couldn't understand how we landed ourselves in such a mess. So thankfully, better sense has prevailed. And one of the arguments I've constantly heard from economists is that even if interest rates come down, the bond yields are not going to come down because government is borrowing so much. Yeah. Despite all that, we've seen 100 basis points fall just from 1st April. So I think one of the arguments has been that RBI should do what it needs to do and let the market forces decide, where interest rates are. On what happens for the falling interest rates, I think it will take another 6 months for it to, come into the market in terms of transmission to investors, to consumers in general, which is why we feel that the cyclical slowdown could change very fast, because as interest rates start to percolate and it gets transmitted to consumers and to corporates, we could first see the consumption cycle turn. The investment cycle obviously will take much longer.
So is it time to buy the bad news, or it's too early to buy the bad news?
We are buying the bad news. So we are saying that given that where the stocks are priced and all the context that I put at the beginning of the interview, we think a lot of the stocks are priced in for bad news. How much more bad can it get? We don't know. But we are assuming that this is a cyclical slowdown, and we're not buying everything on day one. So you stagger your purchases, but you think that this is where I want to build my portfolio.
Why do you like general insurance?
So I think the general insurance business is, if I look at all the other insurance options, this is a very easy market for a good brand to make money. So just the rough ballpark number for general insurance is that your investments are roughly about 4 times of your net worth. So you just keep that as a perspective, rough number I'm saying.
Okay.
So if you make about, say, even assuming you make 6% on your investments, so that's like, I'm 6%, I'm saying post-tax. So that's like 24% ROE for investors. If your combined ratio, you're able to bring it below 100, so whatever extra you get on that goes straight to the investor. So you think about a good general insurance company can easily give you 30% return on equity.
But none of the good companies have a CD ratio which is even 99.
No, there are quite a few which are unlisted, and even the ones which are listed, it's the combined ratio has now fallen below 100.
Yeah, I mean, it's 99.9, 99.7.
Correct, but that's where the opportunity is.
Float. They're not making money in the business.
Correct, so that's where the opportunity. So my context is that if I look at life insurance versus general insurance, just put things in context for life insurance. Their persistency ratio for 61 months is 50%, which means half your customers are not paying your premiums after 5 years. Yeah. You typically end up making money only after 5 years because of the way insurance is structured. So half of them are not paying. The number 2 is that the penetration of life insurance adjusted for per capita. Keep in mind that these are actually financial products. You cannot say we are 2.5-3% penetration, and China is also 3%. Their per capita is 4 times larger than us. So from a penetration standpoint also, this is one of the only product where India is over-penetrated for its per capita. And my last point on life insurance is that there are roughly 300 million life insurance policies outstanding in the market as we speak. The total number of households are roughly 300 million. And if you assume only half of them are insurable, you're already talking of 2 life insurance policies per household. I mean, whichever way I cut it, it looks over-penetrated too.
I'll just put some data and then we'll carry the conversation, which is we've looked at some insurance companies and what is their sensitivity to cars. autos, when I say cars, and that's where the slowdown is. So again, is this a case where right now there is a cyclical slowdown in autos? Auto companies will not, or insurance companies will not come out with good numbers. That's the time you buy the bad news?
Yeah, so I think in general insurance is not just auto, right? So there's a whole basket of products that they have. So you would buy for a longer period. You will not buy because there is a cyclical slowdown today. You would buy because their risk matrix are good. How they underwrite the insurance. To me, that is more important than what is happening to car slowdown in the medium term, or what's happening to any other. There are floods. People get worried about it. Obviously, these are part of the risk that many of the general insurance companies have to manage.
We're nowhere out of the woods when it comes to the overall NBFC crisis, but you did see, the finance minister allowing more power to the Reserve Bank in terms of supervision.
Yeah.
What is the sense that you're getting for NBFCs? Is it a very definitive, differentiating the men from the boys within this space, or are you avoiding altogether?
So to start with, I think this is the best thing to have happened. We have been, representing that this should have happened long before.
You mean more powers to the Reserve Bank?
NHB is a very poor regulator. I'm sorry to say that. If you look at a lot of the mess, we call this an NBFC crisis, but 80% of the problem resides in HFCs, which are governed by NHB.
Yes.
And the problem with the NHB regulations is that you could restructure any of your portfolio without informing either the minority shareholders or the banks. So just to put things in perspective, in the last 5 years, 85% of real estate loans have been lent by HFCs and NBFCs. That number is close to about 2 to 2.5 lakh crores. Now, we all know that real estate has a problem. We all know that many of them are struggling. You look at some of the JLL reports, they say 60% are struggling. Yet, we don't see any NPAs. Where are the large NPAs that we've seen from any of the HFCs? So, the problem is in the reporting. That one, they are evergreening because there is no regulatory, supervision on them. Number two, the reporting is also slack because they are allowed to restructure. So, many of them can argue that this is the law. We have restructured and we don't need to inform you. So I think what has happened is that the regulatory arbitrage will now move away. What we need is an AQR for a lot of the HFCs, like we saw for banks. So many of the banks today are not lending to HFCs because they don't have confidence in the numbers. So I think this is the best thing that could have happened. I would only urge that even the supervision should move out from NHB to the Reserve Bank. So today only the regulatory powers have moved. The supervision is still with NHB. I don't think they have any, skill to do any supervision. We are seeing that from the numbers of one of the HFC, which is in trouble right now, that they have a corporate book close to 50%. And they have always announced that only 20% is corporate. So that's the extent of, misreporting that happens in the system. So I'm very glad that it has happened. I hope AQR also happens.
Is this entire mess in HFCs, NBFCs is something what markets are already pricing in? Let me be slightly more descriptive with my question. If 5 years ago, if we had problems in a corporate group like ADA Group, markets would have gone in panic mode. Now, even though ADA group of companies, they cease to exist from a market standpoint, there is no panic in the market because it's taken 5 years of unwinding, more like peeling an onion. Gradually, layers and layers were peeled off. For the HFCs and NBFCs, if there is a casualty happening, will that send the market in a shockwave, or that is something markets will now remain immune to?
So I think to the extent that it is already known, which is the known casualty, I think the markets will digest it quite well.
So the 2-3 known names, if they go under,
so
also it will not disturb the
because those
market.
are broadly known, it's well dissected. People know what the total exposure is, because not 100% of the exposure is going to go bad. People are anticipating 20-30% is the haircut, which is, I think, manageable. But if we get newer names when the AQR is done, and I hope it is done very soon, that's when there could be a shock. Because we saw that with banks. When we got the AQR and suddenly we got all the numbers, then we suddenly saw that the NPAs were much higher. We all believed the NPAs were higher for banks, but the actual numbers were even higher than what most people anticipate.
So this is not tip of the iceberg. You think this is pretty much the iceberg?
Yeah, we think broadly this is where the maximum issues are right now. And if handled well by Reserve Bank and the government, this is a problem that can be solved. I think they're in the right direction. The fact that Reserve Bank has been given powers to me, it clearly tells me that the government has given the regulator all the powers it needs to move forward.
Okay. Let's look at cement, roads, infra, that entire pack. And I know you said you're, looking at selective picks there. I'm just going to play devil's advocate for a moment. And, while everyone's betting on this big push on that front, private sector capex has come to a standstill. The government itself may not actually have the ability to spend the kind of, the kind of money required to really boost the sector right now, because they've also pretty much stretched their expenditure to the hilt. And, at the same time, some incentives, for instance, maybe on the housing front in the budget, which I'm not sure are going to be enough. Perhaps, you could shed some light on that. So I just want to understand where the optimism is coming from. We know the macro story, but is it really that rosy? Could there be that much potential?
So if I go back last 5 years and see one ministry which has done extremely well, has to be the roads ministry.
Sure.
And they have implemented very well. They've also managed funding. It's not as if the government is funding a lot. So NHA has been able to get funding from outside, be it from Japanese funding or wherever. So the thing is, so we think the same will continue, which is that funding for road projects may not be an issue. So we would continue to see enough number of roads and road related, which is metros. Many of the metros are constructed by states. So look at what's happening to Mumbai. I mean, it looks like an under construction, city. So I think these projects will continue because most people have figured out ways and means to fund. You don't need 100% of the funding. So we don't think funding is an issue as far as many of these projects are concerned. Now, will the SOPs that they've given for housing, will that have significant impact? I don't think so. In fact, I would have thought that they should have pushed the Pradhan Mantri Awas Yojana a bit more. For whatever reason, if you think about the Pradhan Mantri Awas Yojana, where you get a 2 lakh rupees subsidy for a house purchased, which is, say, if you have a salary within 17, 18 lakhs, you're basically saying a house of 60, 70 lakhs can be purchased with that money, because it's 3 times of salaries the loan that you get. That is an opportunity which, for whatever reason, the subsidy numbers are much lower than what most people would have anticipated. So for some reason, that project, scheme hasn't really taken off in the form that it should have. I would have imagined that the government will push or should push that more than this, because keep in mind that only 2% of India's population pays tax. So whom are you benefiting? Only 2%. The 98% can benefit from the Pradhan Mantri Awas Yojana subsidy scheme, and that's fairly significant. The average ticket size for India is about 20-25 lakhs. So if you're giving a 2 lakh subsidy, that's 10% you're giving subsidy. That is more incentive than I could have thought you would need. So in some of the rural India, like when we did our Tamil Nadu trip, some of the cement demand that they mentioned, almost 90% of the rural cement dealers mentioned to us that it was Pradhan Mantri Awas Yojana which was resulting in the incremental cement demand. So I would be bullish on that.
A common friend, Manish Chokhani, always has this view that you always have to focus on not where the puck has moved, but where the puck would move. There are some central themes which always work in the market. When you started your career, it was a bear market, but what worked after the bear market was TMT. The buzz was TMT. Then came private banks. Then came consumption. Next 5 years, what should be the heart of anyone's portfolio?
Yeah, so if I had known...
You will have to perhaps work with some scenarios, right?
So I would say that banking would still be a central theme within that.
AMCs you're saying as well.
No, so I'm just saying banking in general. Within that, we do think financialization of saving is an interesting opportunity, where we've already spoken about, say, insurance, but AMC is also a play there. There are many other opportunities within the financialization of saving, but we think banking as an opportunity, given that many of the intermediaries of the banking are getting now tightly regulated. We are very loosely regulated. Actually benefits the strong banks better. The other thing is consumption, especially discretionary consumption, will continue to grow in
That'll
India.
include autos, that'll include consumer durables.
It could be autos, it could be durables, it could be any of those within the discretionary, because our per capita consumption is so low. So it will move up. I'm not saying staples, because the risk reward on staples isn't so great here. So if you ask me 5 years from here, will I double my money in many of the staples? I don't know. Maybe they will still do it. But I think the risk reward in discretionary is far better, because you have a brand there. And plus, you know that during a cyclical slowdown, many of them trade at deep value. But eventually, when they move, we saw a year back, they were trading at consumer valuations. and ideally they shouldn't be. So I guess that's where we see.
What would you not buy for next 5 years? Whether it's because of disruption or bad capital allocation, the dynamics of the industry. I mean, there are a lot of businesses which are in demand right now. After 5 years, they may not be existing.
Yeah, so IT is a sector that I'm not very bullish on.
Okay, the top names. You'll not buy the top names.
I'm saying the sector.
Okay. Sure.
Because I think the disruptions that are happening because of AI and many of the other changes that are happening can impact the Indian IT companies drastically because they haven't really innovated. Look at the innovation that Chinese companies have done. 10 years back, there were no large Chinese IT companies. Today, you have at least 3-4 in the top 20 of them. So in my view, the Indian companies haven't disrupted themselves enough, and they've continued the model of, the cheap labor. So I think they've missed the bus. The other thing I think is utilities. I mean, given the disruption that may happen because of solar and battery operated, the battery technology that is improving, the amount of money that is going in that sector, we think eventually many of the utilities will find it very difficult because we all may have a solar panel in our house and a battery.
And we don't realize before we wrap that how much of importance is now being given on environment. Yes. I mean, the utilities amount of carbon and amount of carbon dioxide they emit, I think I think that there would be a serious change happening. I appreciate your time. Always good to have you back.
Thank you.